Hello guys, welcome to this new video on inflation. This is a very important topic which you should be aware of because this is a topic which affects each and every person on this planet. So my aim in this video was to make you understand in a more simplified manner, and to better understand the whole concept you should watch this video till the end, and also a lot of effort goes into making these videos. So what you should do is watch the videos till the end to better understand the topics, because that is the aim of these videos. Inflation, as I said, affects each and every person on this planet, and this is one concept which everyone should be aware of. So without wasting any more time, we will start discussing the topics which are part of this video. Firstly, we are going to look at what is inflation, why does it go up, inflation around the world, how is it controlled, what do the central banks and the governments do to control inflation, and what effects do inflation rates have on various companies. So let's go and let's discuss the various topics which we are going to discuss in this video. So there have been a lot of headlines all over the world that in that part of the world the inflation rates are increasing, or in US the increase in inflation is happening on a massive scale. So there were a lot of headlines around that inflation is going to affect this way, inflation is going to affect that way. But what we should do is first understand what is inflation. So inflation in the most common sense is the loss in your purchasing power over time. So what does that mean? For example, this year I have 100 rupees in my pocket. The purchasing power of that 100 rupees is right now 100. But with the inflation rate of 7%, the purchasing power of that 100 rupees next year will be 93 rupees. So what has happened? My purchasing power has decreased. So in the most basic manner, inflation is the erosion of your purchasing power. And how does that happen? That happens because the prices of goods and services are increasing. Now let's discuss how does inflation go up. So during COVID, if you would have seen, when COVID had hit around the world, inflation rates came down around 2%, and at that point inflation wasn't that high. But now if you see in US, inflation is around 7.5%. So why did it go up? It went up because the production cost of goods went up. Raw materials needed for producing goods also went up. So because of that, production cost went up, and in that manner, because of higher production cost, the prices of goods started to go up. So one reason, price went up. Another reason, demand starts to come up. So demand starts increasing in the economy. When COVID had hit, a lot of people had to be unemployed, and the unemployment rate went up, and because of that there wasn't big demand in the economy. So increase in demand because of economic recovery leads to higher inflation. Increase in housing prices is also an indicator that inflation is going up, and real estate is impacted well in a positive manner when the inflation rates are going up. Why? Because if you see, when COVID-19 had hit the world, the interest rates were about zero, and the central banks had decreased the interest rates. So the loan you could get on interest rates, the interest rates on loan was very low. So the borrowing costs were very low. And what happened because of that, home loan rates were very less. And because of that, the housing demand went up because the loans were easily available. So because of that, the housing market started to increase, and right now housing market is doing very well because the interest rates on house loans are very low. Then there is expansionary fiscal policy. Firstly, what is fiscal policy? Fiscal policy is the policy which is implemented by the government, And what is monetary policy? Monetary policy is implemented by the central bank of the economy. So expansionary fiscal policy leads to inflation. So if a government cuts taxes, businesses may spend more because of capital improvements. Corporate taxes are lower, so that would lead to more investments on or more money spending on employee compensation or new hiring, which will lead to lower unemployment, and then people will have more money to spend. That way, the government is helping out in increasing the demand of products. Then what is expansionary monetary policy? So expansionary monetary policy by central banks is lowering of interest rates. So interest rates were about zero, were at the lowest for the last 1.5 years. So what happened was central banks were increasing the demand of products in the economy. Central banks like RBI, Federal Reserve, lowered the cost for banks to lend. If, for example, the loans were at 8%, just an example, so now the loans were available for 1-2%. So the banks could lend at a lower interest rate, and then people were borrowing more. So when people borrow more, they spend more. And when they spend more, companies are being benefited because their profits are increasing. So businesses and consumer benefit from a lower interest rate. So this is a whole cycle. Interest rates are lower. Because of that, the lower interest rates, people borrow more. When they borrow more, they spend more. And when they spend more, the profits of the companies are higher. So the increase in available money in the economy leads to more spending, as we've discussed. And the best example you could get is in the recent times when COVID had hit. The Federal Reserve and the US individuals, people in US started to get stimulus check. And what happened was that led to people spending more, and because of that, prices of goods went higher. Individuals also put their money of their stimulus check in stocks and cryptocurrencies, which led to recovery in the stock market at a faster pace, and that leads to the well-being of these companies. So this is how the inflation is going up. Now let's discuss how inflation rates affect companies. A higher inflation will lower profits because the production cost of products is higher. So if the production costs are higher, my profits will be lower. Lower profits would lead to a slower growth of companies. Best example to look at is crude oil prices have been increasing for the last 2 years. Crude oil is a raw material in industrial companies in sectors such as auto, paint, chemicals, etc. So the profits of these companies will go down because the raw material which they have, the prices of that raw material has gone up. So it is very important for an investor to analyze the commodities which affect the companies. If the prices of the company, the raw material which is used is going up, that might eat up the profits of that company. So it helps you to analyze how commodity prices will affect companies' profits. Now let's discuss how inflation is controlled. So a higher inflation can be controlled by various factors through monetary policy and through fiscal policy. So monetary policy, as I told you, is through the central banks, and fiscal policy is through the government. So what happens through monetary policy is that the increase starts to happen in interest rates. The lower interest rates regime doesn't stay, and the interest rates are increased by the central bank, and the talks about this is going on right now. So what will happen because of the higher interest rates? There will be a lower demand of goods because the loans are available at a higher price. The interest rates are higher at this point, so the people might borrow less, and less borrowing would lead to lower demand for the products. So higher demand for higher borrowing cost for car loans, for example, would lead to a lower demand for cars. So in a way, the prices of those products would start to come down. And what will happen through fiscal policy? A higher rate of income tax could reduce spending, demand, and inflationary pressures on the economy. Now, what does the effect of high inflation have on stock market? I wanted to explain this topic in the most basic manner possible. So there you go. The most basic explanation is that, for example, current fixed rate is 5%. So the FD fixed deposit rates are 5%. So what will happen when the interest rates are increasing from 5% to 8% because of the change in policies? What will happen is these instruments will start to go up in demand, and the money will start going into these instruments such as fixed deposits. So from where will that money come? That money will come from the stock market. People will look to take out money from the stock market and look to invest that money in fixed deposit. Why are they doing that? Because fixed deposits are less riskier, and people who don't want to take risk will prefer going into an instrument which has about, if equities have 12% return, they have 8% return. So they are giving up the 4% which they could get more, but they are lowering their risk because of that. So risk averse people would start to go in and invest in fixed deposit rates. So this will be the effect on stock market. Now finally, the big question: what are inflation hedge instruments, and where should your money go when inflation is rising? So inflation hedge instruments are those instruments wherein the price of those instruments go up when inflation is going up. So as we discussed, commodity prices go up when inflation is going up. So you can invest in commodities such as crude oil, aluminium, steel, etc. to get exposure of inflation hedge instrument. Second, prices of gold and silver go up in a high inflationary environment. Then the real estate prices, as we discussed, because of the lower house loans interest rate, because of that the real estate prices also start to go up. And now we have a new instrument which helps you to weather out the higher inflation, and that is cryptocurrency. So guys, this was the whole topic about inflation, what happens in a high inflation environment, and how does it affect each and every one, and what you should do in these kind of environments. So if you like this video, do hit the like button, and don't forget to subscribe to the channel if you still haven't. Thank you.